Shareholder basis is a critical concept that determines how much of an S corporation's losses you can deduct and whether distributions you receive are taxable. Understanding this financial measure can save you thousands in taxes and help you avoid IRS penalties. S corporations offer the advantage of single-level taxation, unlike C corporations which face double taxation. When an S corporation generates income, that income passes through to shareholders who report it on their individual tax returns. But this tax benefit comes with specific tracking requirements. Shareholder basis represents your investment in an S corporation. Think of it as a running balance that increases with your contributions and share of company profits, and decreases with distributions and losses. Without sufficient basis, you cannot deduct company losses on your personal tax return, and distributions may become taxable. There are two distinct types of basis that S corporation shareholders must track. Stock basis reflects your capital investment in the corporation, including your initial stock purchase and additional contributions. Debt basis only exists when you personally lend money directly to the S corporation. This distinction is important because losses must first reduce stock basis before touching debt basis. The IRS requires a specific order for basis adjustments. First, your basis increases with capital contributions, your share of income, and gains on asset sales. Then, it decreases with distributions, your share of losses, and non-deductible expenses. Unlike partnerships, S corporation shareholders do not receive basis for company liabilities. When losses exceed your available basis, those excess losses become suspended. These suspended losses aren't lost forever. They carry forward indefinitely until you restore sufficient basis. However, if you sell your stock without restoring basis, those suspended losses disappear permanently. Distributions from an S corporation are generally tax-free to the extent of your basis. Once distributions exceed your basis, they become taxable as capital gains. This makes accurate basis tracking essential for proper tax reporting. Not all loans qualify for debt basis. The loan must be direct from you to the corporation and represent a genuine debt obligation. Simply guaranteeing a third-party loan doesn't create debt basis unless you're actually forced to make payments on that guarantee. Beginning in tax year 2018, the IRS began requiring shareholders who report losses, receive distributions, or dispose of stock to attach basis calculations to their tax returns. This increased scrutiny means maintaining detailed records is more important than ever. To stay compliant, maintain annual basis worksheets, loan documentation, schedules of all contributions and distributions, and copies of every Schedule K-1 you receive. Many shareholders rely on tax professionals to handle these complex calculations, especially when dealing with multiple years of adjustments. Proper basis tracking prevents costly tax errors. Without accurate records, you risk having legitimate losses disallowed, paying unnecessary taxes on distributions, or miscalculating gains when selling your shares. The financial consequences of improper basis tracking can far outweigh the effort required to maintain good records. Understanding shareholder basis is fundamental to maximizing the tax benefits of S corporation ownership. By tracking your basis diligently and understanding how various transactions affect it, you can make informed financial decisions and ensure compliance with IRS requirements.